mind, and you're trying to capture some of that. I'm sure there's always more to be done, but thank you. Yuan Yang, MP.
Thank you, Chair. I'd like to turn now to talking about quantitative tightening and what came before QT. And thank you, Governor, for your correspondence with the Chancellor over the asset purchase facility arrangements, which the committee has seen. As part of those arrangements, as you know, the Treasury is now effectively paying out interest payments to commercial banks for the reserves they're holding with the Bank of England via the facility. How much do you expect the Treasury to pay out over the course of this next Parliament, and how fiscally significant is this payment in terms of constraining what the Chancellor can do with the budget?
Well, I can't give you a figure for the next Parliament, I'm afraid, because that would depend on a lot of assumptions. I mean, we publish the reports are published quite regularly, but they do depend on a lot of assumptions. So I can tell you the current sort of balance of cash, if you like, in terms of cash flow. So the bank paid over to the Treasury £124 billion during the sort of the phase essentially when quantitative easing was going on until interest rates started to rise. Currently, that number remains plus 70, so essentially 54 has been paid. It's come back the other way in terms of cash payments from the Treasury to us. So there remains a 70 plus 70 on that level of accounting.
In the last financial year, about, is it 20-30 billion? That's that the Treasury has paid to the bank.
Yeah. Now, it depends on a number of things. It depends on interest rates, on where the curve is, because as you rightly said, quite a bit of this comes from the difference between obviously the price we paid for the gilts and therefore the discounted income flow on that, and obviously what is now being paid on the as you said, by us on the reserve accounts. By the way, you may want to come on to this. That is not a link that we make closely. I mean, the remuneration that we pay on reserve accounts is done for other reasons, but that you can make that sort of connection in our balance sheet. So it will depend on the curve. It will also depend upon the timing of sales that we make. But let me be very clear on that. That is all about in a sense, the timing of these cash flows. It wouldn't, for a given curve, affect the overall cash flow over the life of the thing.
But for the current Parliament, what matters is the budget constraints in-year budget constraints over single.
Well, but then if you don't mind me saying so, you also obviously need to, and this is where you really need the Treasury to talk about this, as to how that feeds through into the fiscal arithmetic, which of course has changed in the budget in terms of the way in which the fiscal rule is set up.
But right now, over the last year, you're looking at something like 20 to 30 billion in transfers from the Treasury back to the.
Well, the cash flow the other way, yes.
Yeah. Are there better means technically of ensuring better value for money, so that the Treasury has to make less payments of that kind?
Can I make another point which distinguishes us from other central banks? So many other central banks you're not seeing the cash flow happen, even though they've got essentially very similar positions to us. Now, the reason for that is that they are able to, I'm going to do some slightly abstruse accounting at this point, they're able to book deferred assets. The central banks are able to book deferred assets onto their balance, onto their own accounts. Now, why are they able to do that? Well, I'm going to put aside the fact they've got different accounting standards, but let's put that to one side. The reason is that they retain the profits that they earn from the note issue and then pay them out to their treasuries by some process of usually annual agreement or whatever. Yeah. Now, therefore they have an income stream which they can offset against the cash flows. But of course it means that they won't be paying over the money that they would otherwise be paying over as the profits of the note issue. Now, because of an act passed in 1844 by Sir Robert Peel, we don't have that, because in fact we pay all the cash, what's called the seigniorage, the profits of the note issue are paid over immediately. So for the last year, we're probably paying about £5 billion a year over. Now, we can't do that piece of accounting, because to do that piece of accounting, you've got to have some income. You can't book, obviously, a deferred asset and have no income in the future to offset it against. Economically, I'm afraid it makes no difference, I think, at all. However, optically, it does. I recognise that we're in a situation where these cash flows are having to come back. All I would say is there's another cash flow going the other way, and will be going the other way permanently, which other central banks are using to offset. We can't do that. So it looks different in this country. I think one benefit of our arrangements is more transparent. I have to be honest, slightly painfully transparent, but it is a more transparent system.
Sure. And so that's one channel that's closed off to the bank. And you mentioned the importance of that interest payment on reserves for other means. I presume you mean the monetary transmission mechanism. Previously, the bank has made technical preparations, I think 3 years ago, to introduce a tiered reserve system to see if that was possible. And of course, the European Central Bank has done so previously. Is the infrastructure in place to implement such a system after you've done that?
Well, can I say, the European Central Bank has a somewhat historic minimum reserve provision. It's historic, really going way back to when they were doing monetary targeting, actually. It's very small, I should say. This often gets exaggerated in the telling. That minimum reserve requirement is very small as a proportion of reserves. Our system, we don't have that. Could we introduce a tiering structure? Well, yeah, over time, yes, we could. It would require us to do quite a lot of changing to our systems, but we could do it, yes. But can I just say this from the point of view of the substance of the issue? That is not something that actually is at all necessary for us to do to pursue our objectives, either of monetary policy or financial stability. Indeed, I would argue, and I have said this in previous commentary, that I think it is actually somewhat inconsistent with our monetary policy objectives, because we pay the policy rate on reserves, and that helps us to anchor the interest rate curve at the policy rate, which of course is critical to the MPC pursuing its objective.
Of course, and I take that point, but also that value for money is a consideration for the Treasury and also for the programme and pace of quantitative easing. Well, is there any value for money consideration in that arrangement?
Well, can I say on value for money? I think it depends what you mean by value for money. If you look at value for money in the context of what we've done over the last 15 years, then I think you have to look at the overall economic effects of quantitative easing and quantitative tightening that are now going on. The cash flows don't answer that question for you. I just to be very clear on that. That question is not answered by the cash flows. That's an economic question. So that's the appropriate way to look at value for money. If you then come to the question of tiering, I mean, I'm going to be quite blunt about this. It's a tax on the banking system. It's not something that's needed for our objectives. It doesn't enhance the sort of the value for money of our objectives at all. So it would be a fiscal decision, not either a financial stability decision or a monetary policy decision.
Sure.
Can I ask a quickie on this? Have you finished?
I've just got a quick minute and ask follow-up.
It sounds as though you've been asked to do a lot of work on this by the government, though.
No, in the past we have looked at the question in various ways in the past, but there's no big work programme going on. Let me assure you on that.
Sure. And similarly to Dame Harriet's question, you've previously spoken to the Lords Committee and told them that the bank couldn't act to change that arrangement of paying interest on reserves on its own. What kind of partnership would you need from other parts of government, and what conversations have you had with them on this issue?
Well, we would, first of all, I'm very clear, and I've said this before, it is rightly a decision for government. It's not a decision for us. We do not need to do this to pursue our objectives. In fact, I would argue it's contrary to our objectives in that sense. So it's not a decision for us. So it would require a decision from government to do that. So they would have to be the takers of that decision.
Thank you.
And I'll move to talking about distributional impacts for Ms. Lombardelli. And what's your latest assessment of the impact of QE on inequality? And do you see that QT is undoing any of that impact? Or do you think that there's a risk of a ratchet effect where it stays, it's much more easy to increase rather than decrease the level of inequality?
Well, I mean, we've done work in the past on the impact of QE on sort of distributional outcomes, and actually linking a bit to what the governor was saying. You obviously have to take a sort of overall economic perspective on what QE did and does in supporting the economy. And when you look at that, what you see actually is it supports everyone across the economy, but of course those people on low incomes within that. So we have done that analysis. The bank has done that analysis in the past. We haven't. The bank hasn't done sort of specific analysis of the distributional impacts of QT, but we have done quite a lot of analysis of the impact of QT. And what that shows basically is actually very small impacts of quantitative tightening. That's completely consistent with all the sort of academic literature out there. I would say, I mean, there's limited available evidence because QT programs have only been going, for quite a short period of time. They tend to have been smaller. But what that evidence basically seems to suggest is, if anything, a very small impact of QT. So you wouldn't expect it to have particularly changed the broader conclusions about QE. And it shows the sorts of things you would expect, which is, the QE obviously is sort of implemented in a different environment. Quite often it's the times when you're facing shocks. The QT program is particularly designed to be sort of very kind of stable in the background, just happening, and not the sort of active policy tool, not in response to shocks, if you like. So you get slightly different results, but the overall impacts that we see so far, and of course, as I say, all this evidence is emerging, and we'll know a lot more about QT in a few years when more countries are doing it and more of it's happened, but quite small impacts in terms of the economic impact of QT.
Okay,
Can
Governor.
I just come back on Dame Harriet's question? I just wouldn't mind putting this question to rest because it was occurring to me, I was thinking, you referred to work that was done 3 years ago. And just to be clear on what that work was, because it's relevant to Dame Harriet's question. So 3 years ago, I remember we were looking at the question of whether we would and could introduce negative interest rates.
Yes.
Believe it or not, I mean, it sounds like a different world, but we were. Now, other central banks that had done negative interest rates actually did them through a system of tiering their reserve remuneration, so they didn't move to negative interest rates on the whole of their reserve stock. So that's what I think what's occurring to me, that's what you're referring to. So you're right that we did work at that point to say, if we were to move to negative interest rates, could we tier remuneration on reserves? And you're right, Dame Harriet, we did do some work on that question.
But not with the new government.
It wasn't, this goes back to the previous government.
Nothing since.
Not since July the 4th, yeah.
Okay. Thank you very much. Lola McAvoy, MP.
Sorry, I just had another question to probe a bit further on the global impact. So on the other approaches that the big central banks globally have taken, and any potential economic advantages to those economies because of their different approach. Has there been any work done, or have you got any thoughts about that? Not specifically, I know it's not within your remit as you've outlined to make the decision, but I'd be interested in other members of the panel, maybe Dr. Mann, if there's been any, what your opinion is on the impacts of the other approaches that the central banks are using.
I would agree with what the governor said here, which is that the accounting, the nature of accounting for the profits or losses associated with holdings of different assets has not affected the conduct of the central bank's decision making, the conduct. The two of them are separate. To the extent that there are fiscal considerations, for example, in the U.S. there aren't because of this deferred asset. In Europe, the complexity of the different sovereigns on the balance sheet create their own challenges. And so these are accounting issues. I do think that the financial markets have looked through this. If we think that there should be if there's a conduct issue, a different choice of monetary policy because of these accounting strategies, the financial markets would seize on that pretty quickly. But the fact is they've looked through it because they separate out what it is that the monetary policy authorities need to do for their jurisdiction, and then this accounting thing is on the other side. And it's not affecting the decisions that are relevant to the jurisdictions on which they're basing their monetary policy decisions.
Okay.
If I can add on this, actually, in my previous role at the OECD, I actually wanted to do some work on international comparisons of these things, and actually you very quickly find you can't because the UK is very transparent, lots of other countries are a lot less transparent than that, and so it's actually quite difficult to get comparable data on these things, which it can be quite frustrating when you want to do research into them.
Can I just bring in Professor Taylor? Obviously, with your hat of a economic history guru, shall we say, expert, could you tell us if there are any examples of a differing approach having a beneficial outcome for an economy?
Well, I think central banks have been experimenting with different kinds of intervention for 500 years, and that's a very rich history. And as the governor mentioned, there are all kinds of interesting laws passed at various times that, we're still living with. I think as it pertains to the last 10 or 15 years, that history is still to be written. I think the judgment on QE will be that it's a tool that needs to be there in extremis and in those crisis moments, as Claire Lombardelli mentioned. It may be the only tool you have that can avert, a major financial breakdown in markets and avoid the counterfactual of an even worse recession. In normal times, you may want to unwind that. That's what QT is about, and that should proceed more smoothly because it's not being implemented in the same dramatic fashion. And, there's a move now towards a repo-based system of providing liquidity through borrowed reserves, which takes away a lot of the interest rate risk questions that have arisen. So I think there we're moving in a healthy direction and hopefully learning lessons from the past. But I think the most interesting conversation was about the accounting. I mean, it kind of seems obscure, but that is something that is just a quirk of the way we do our accounting here. But as the governor said, that's sort of optically interesting, but in terms of the underlying economics, maybe not as much.
Yeah, you'll forgive us because it feels like quite an expensive quirk. Annually. I know it's
right.
not, as you've explained.
But it's also maybe not so much the choice of the bank, but if one wants to change the accounting, okay.
Indeed.
Can I just clarify something, Governor? You previously said, thank you, Chair. Just to clarify, Governor, you previously said that tiering reserves might run counter to your objectives when it comes to increasing the value for money on QE. In what way would it be counter to your objectives?
We don't need to tier reserves to achieve our objectives.
So would it be counter to them, or would it?
Well, from the point of view of monetary policy, by far the simplest system is that we hold reserve accounts and we pay the policy rate on the reserve accounts. We don't pay some mixture of different rates. And if we did pay a mixture of different rates, at the margin, that could have some effect on the transmission of monetary policy. So that's really my point. I think the simplest system we have is the one we have, which is we pay the policy rate on the reserve accounts. Now, it actually goes to what Alan was just saying, because moving to a system where we use repo to fund the reserve accounts, which is sort of something I set out in a lecture I gave at the LSE earlier this year, is, to my mind, the most attractive system we can move to, because it means that the interest rate risk is taken off our balance sheet. In other words, we've essentially got a bank rate on either side of the calculation. We're in the middle, but we're not taking interest rate risk. Now, that wouldn't, of course, get away from the question of, well, would you do quantitative easing in the future? Because quantitative easing, in a sense, is where we deliberately take that risk onto it's a policy choice to do that. But in normal circumstances, I would like us to move to a world where we don't have that risk on our balance sheet. That risk is left out in the banking system.
Okay, thank you very much. John Glenn, MP.
Thank you, Chair. Could I turn to the impact of some of the budget decisions overall on inflation, interest rates and growth? And could I ask you, Ms. Lombardelli, about the assumptions made about the stimulus effect and the crowding out effect? There seems to be some differences potentially around how the OBR have assessed the effect on the national insurance increases, and obviously that will play out, and decision making from your panels and others will indicate how that goes forward. But could you explain what fiscal multipliers you used and why there's a difference between the OBR's assessment on NIC's impact on behaviours and what you've decided?
Yeah, sure. I mean, I would say that sort of big picture, actually, the way in which we have assessed the budget and the way in which the OBR have assessed the budget are very, very similar. So, we think the impact on growth by the end of next year, we have that as kind of 0.7% on growth. They've got 0.6 on inflation. The numbers are very similar. There are some differences, like you say, and they derive from two things, really. One is around the way in which we look at the multipliers. So, again, we both follow the sort of totally standard economic approach, which is, a certain sort of spending happens, and we ask the question, well, what proportion of that feeds through into demand? For some things, it might be 100%. For some things, it might be less. Now, the OBR and we have slightly different numbers. There's two reasons for that. One is we both look at the literature and you know, there's a lot of uncertainty in that as a range of views, and both of us ground our numbers in the literature, but they might be slightly different. And I should say we do this, both of us do this, where you basically take the types of spending, so capital investment, welfare, tax, and you think about the time over, so the first year, second year, third year, and so on. So we have slightly different numbers, but they're not big differences, and they're, you know, you could argue about them. The literature does. But neither of us are doing anything that's particularly unusual in that space. The other way in which they're different is the OBR embed in their multipliers changes to interest rates and other market exchange rates and other things. We don't, because we take those separately from the market. So you might expect, so for the OBR, they think about the impact of the government spending, and they think, well, there'll be all sorts of consequences of that, including the consequence on interest rates and exchange rates. What we would do is just take those from the market. So again, you get those are just different modelling approaches that should get you to exactly the same, and they're sort of theoretically the same. They, you know, you might get slightly different numbers because of the way in which markets have moved or so you've got a difference in the multipliers. The other thing that you've got that's going on that's slightly different is our judgment about the amount of spare capacity in the economy. Now again, I wouldn't over interpret the differences here. I think both of us basically believe at the moment the economy's broadly in balance in terms of demand and supply. Now, I would say at this point, it's very hard to make judgments about spare capacity, the output gap, all those sorts of things. So it's really hard to know, right? It's hard to know now, it's hard to know what it'll be in the future. I mean, frankly, economists find it hard to know what's happened in the past. But the output gap's really, really difficult to judge. But for lots of reasons, you think broadly in balance seems about right. Unemployment is quite stable, vacancies are coming down. You know, it doesn't feel like there's a huge amount of excess capacity in the economy. So you've got those things. Now, over our forecasts, we think that some spare capacity will open up in the economy in response to monetary policy being tight. Actually, fiscal policy will tighten in the later years of the so we think there might be some spare capacity that emerges in the economy. The OBR actually take a slightly different view. They have more of the impacts of the budget in the near term, so their multipliers are higher in year one than ours are, for example. So they have a bigger impact. They think actually there might be excess demand in the economy, and that's why they think that there's, they've got crowding out in its traditional sense of, is there more competition from resources? Because we think an element of slack will open up, we don't have that traditional sense of crowding out. But we do think that demand will be higher because of the budget next year, the year after, and therefore inflation will be higher. So, sorry, that was quite a long-winded way to basically say... It's very
helpful to hear it.
There are, the big picture, they're not massive differences, but there are some differences in the detail.
Mr. Glenn. Very much. Could I ask the Governor about the budget impact? And obviously you predict in the near term an increase in inflation and GDP, but the bank is sort of less clear about interest rates. I mean, the guidance in September was different to where, and the OBR say that there'll be in effect the interest rates go up by 0.25%, I think. Can you explain the bank's thinking with respect to interest rates and why there's no sort of assessment, or why there isn't some clarity over the expectations of interest rate effects?
Well, we don't take, as a matter of course, actually, we don't take a view on what interest rates are going to be going forwards. We obviously, in our forecast, we condition it on the market curve. The market curve did move, and the market curve instantly moved around about the budget by pretty much what the OBR was put in, so about 25 basis points. So you can observe that if you look at the market's profile for what they think we're going to do, it moved by about 25 basis points. You're right. So we obviously factor that into our forecast, but we don't take a view ourselves going forward on what interest rates are going to be. And going back to what we've been discussing, what Claire was just saying, my guess is anyway that will change over time.
Perhaps I could turn to Dr. Mann and Professor Taylor then, in terms of the September guidance that was a gradual approach to removing policy restraint remains appropriate. Can you talk about the interaction between that guidance and what expectations you had of how expansionary the budget would be, and where you'll next be, when we would get an assessment of or how that guidance could evolve?
Yeah, so I think we didn't know all the details of the budget ahead of time.
There was a lot given to
was
aired
quite a lot
in
of
the media.
A lot of things were heard, but we didn't know for sure. So the bank staff received information that week, and in terms of talking of spare capacity, there was no spare capacity there. I need to thank the bank staff for doing an amazing job to give us some guidance with updated forecasts, which have been incredibly informative. So I think we were looking at, in the November round, we're looking at the changes from the budget, but the changes from all the other things that have been happening that we've talked about, that the inflation numbers were coming down under. We also had a sense that savings was elevated, and there was some maybe lower demand pressures than we otherwise would have anticipated. So the update in November reflected all of that in the whole. So I think that was kind of the basis for the November decision. There were lots of offsetting factors. The actual effect in terms of demand pressure from the budget that the staff have here in Chart B, page 29, the demand pressure is only really about half the story. I mean, a lot of the inflation deviation is in year 1 and 2 due to other budget changes, various one-time tax changes, and a certain path of fuel duty, which is not ineluctable. It's actually assumed here to follow a given path. And
is that wise, though, just on that fuel duty point, that 0.2% effect of that, why is that? I mean, it's
just what we do.
It's a policy decision that keeps, I get that, but it's a policy decision that has kept rolling over, and shouldn't the default setting be that it will be rolled over rather than the other way around?
Well, can I just come on that?
I thought you would.
Look, we condition on announced government policies.
Yeah.
I take your point that this is one that has been stated policy that hasn't happened for a long time now, actually. But
to pick up Ms. Lombardelli's point, economists not knowing always can't tell from what's gone on in the past. In this case, that would be rather a good indication.
I tell you what my concern is here, that would put us on a slippery slope towards essentially making our own judgments on what policy was going to be, and we really don't want to go there. Sorry.
It's a question better directed to the politicians.
To come back to the question what it means for inflation, I think if I look at the blue bars in Chart B, which are about the demand pressure, that's where your feel is as an economist, that's the underlying inflation impact that's happening in a sustained way, as opposed to one-time tax or price measures, which you may or may not believe, but we have to factor those in. But in terms of where you would put the weight, in terms of the driver of underlying inflation, it would be on the blue bars that are working through demand in the economy. And they're up about 20-25 basis points there, and they've been offset, of course, in the overall forecast by declining price pressures elsewhere, and our demand judgments changing because we've seen maybe more savings and other effects. So that I think is one way to read that chart.
Thank you.
So the committee uses the gradual language. I do not.
Well, it's good.
But it is a committee document, and that's why it's there. So I've taken the view that a more activist strategy is superior. And this is for a couple of reasons, a number of which I've already outlined with regard to the underlying inflation pressures. But I start by noting that the restrictiveness of monetary policy is less, in my view, than has been incorporated into our models under the standard assumptions. And that's principally because the starting point for the hiking cycle didn't start at 0, or the effective lower bound. It started at about at -350. So that is one reason for why I think it is important to hold as opposed to pursue this gradual strategy. The second aspect with regard to the degree of restrictiveness of monetary policy is, of course, where we think we're going to end up in the longer term. And my view is this so-called R-star, or the neutral interest rate at which the economy will be in balance, is much higher than is incorporated in our models, and as a hence, the current stance of monetary policy is not particularly restrictive. Now, going to where how does that translate into not being a gradualist? There are a couple of other elements that I think are important. as I said, it allows more time to evaluate whether or not the upside risks to inflation that I've outlined materialize. I think that's an important thing to consider because of the upward bias and the ratchet effect that we have in the inflation process. Secondly, I won't hold forever. I mean, I've said that publicly before, so no news there. But when I do cut, it will be more aggressive because I will have received the signals that I need from the data, whether it be demand, whether it be supply, whether it be through prices and wages, that an appropriate stance is to cut by a larger amount. Now, the rationale for doing that is multiple. First, the research shows that firms do respond immediately to a strong signal from the central bank that the decision has been made based on information coming in. So that strong signal, an immediate response of firms, which our research shows, is a different type of channel of transmission of monetary policy than the common view, which is it takes a long time for it to filter through. Some of it does take a long time, but there's also an immediate response, which means that monetary policy has more traction in the near term than some models would incorporate. The second thing is with a larger, frankly, these days, with a larger movement, it's clearer signal. Like, we're definitely making a change based on information. And I do believe that clearer communication in today's climate of volatility and financial markets moving around quite a bit, that clear signal cuts through the noise of the financial market behavior. And my last point on gradualism, frankly, is that, in my view, it allows the persistence that we've been struggling with, it allows it to drag on for longer. And why do we want that?
Thank you for your clarity.
Mr. Glenn.
I've finished. I've passed.
Okay, Chris Coughlin.
Thank you. Governor, in your Mansion House speech, you spoke about the vital importance of improving UK productivity, and that's linked to capital deepening, that the UK has continually been at the bottom of the G7 league table for investment since the 1990s, and also that public investment is a foundation of business investment. But in the budget, UK public investment remains flat as a share of GDP, so therefore how can we expect the budget to improve UK productivity? And I'll be interested in other members' views as well.
Well, I mean, I think obviously it's really a question for the Chancellor to ask. What I would say this is that obviously, that flat profile of investment was against obviously what was a very challenging budget from the point of view of the overall budget position. So, but that's a judgment. Really, you have to ask the Chancellor how she made that judgment. But I would just make that point that obviously, it has to be assessed against the overall outcome. I think it's sensible that the fiscal rules have been amended to A, put a sharper relief on investment, and B, potentially create more headroom for it.
So I think there are two channels through which the budget could have potential productivity enhancing outcomes. We've already talked about one in the context of how firms might respond to the change in labor costs. One strategy is to undertake productivity enhancing investments that would be supportive of the higher real wages that would be part of the equation here. So that's one way in which you get investment and productivity growth. But the second way is, let's suppose this demand factor really has traction throughout the economy. Again, the research that we do looking at firm level data shows that so-called sales surprises, as in I was a firm, I did a forecast looking forward a year, I thought my sales were going to be a certain amount. Now the budget comes in, it is demand driven, front loaded, it is widely distributed throughout the economy. Firms get a sales surprise. When firms get a sales surprise, they respond with higher investment. Again, productivity enhancing strategy. So those are two channels through which you could get a productivity gain.
Sure, but presumably much less than if more of the budget was on public investment versus 2/3 of it being on.
Well, but those are incorporated
Sure.
the multipliers already.
Yeah, of course.
Let me add a couple of things. So, look, I mean, the budget is obviously one part of the government's policy, and you know, the Chancellor should, you know, we'll talk about more widely about that. There's obviously the things that were announced at Mansion House last week. There's others, planning and the like. A few things I would say from our perspective, which is obviously productivity, you know, as you say. I mean, huge challenge for the UK. It is relevant to monetary policy insofar as, you know, it determines how fast the economy can grow in a non-inflationary way, and of course it's the only long way to drive up real incomes. But productivity depends on a whole set of things. Public investment is one. I mean, private investment is an area where the UK has also lagged behind its counterparts, and that is absolutely critical, because if you think every worker, how much capital are they, you know, how efficient they're being. It's about the other thing that's really critical is skills and human capital, and this is an area where economics has really sort of, our understanding of the importance of human capital has really changed over you know, the last few decades. And if you look forward to how economies are changing and evolving and technology and all that, you can see an even greater role for that. So, you know, the budget obviously covered some of this, but I'm sure the government will think more broadly about it.
Yeah, I think in the long run, productivity is everything, and the central bank and monetary policy can try and provide the foundations for that through a credible nominal anchor and financial stability. I think the UK has special problems, but also has some of the same common problems of many advanced countries. The trend growth has been slowing. Demographic trends and other trends have, you know, been a headwind. But the UK seems to have been, you know, at the bottom of the pack, as you say. So I think there's a broad range of questions there. I mean, again, talking to the agents, I got a sense that, you know, that firms are concerned about skills and education, as Claire Lombardelli mentioned, and there are, you know, that can be addressed through a broad range of government policies, but it won't just be what the budget says, and the planning revisions may also help. So I think there's scope for upside. At the same time, we're coming out of a lot of uncertainty shocks, very negative shocks for the economy. If we could have a quiet decade, maybe things will suddenly look up.
Yeah, exactly.
I wouldn't bank on it, but we'd like to.
Last one, I think.
Final question. So, as we've been discussing, the budget is forecast to be inflationary. Given that, to what extent does it make sense for the bank to be increasing interest rates to respond to that government-induced inflation? And if that does control inflation, isn't there a risk that that will then hamper growth and productivity?
Well, I mean, the response of interest rates should
and the cost of borrowing for firms.
Should obviously take into account whether we think inflation is going to be sustainably at our target. Yeah. So, it goes back to the earlier question. Yes, it has had the effect of putting something more onto the sort of this profile. We had this profile before, actually, which is really to do with the unwinding of some of the shocks we've had. But our judgment is really aimed not at that. It's aimed at, do we think, based with the interest rate we have and the path of interest rates that the market thinks we have, there will be sufficient restriction in the path of interest rates to bring inflation sustainably back to target? That's the judgment we have to take. Now, you've heard different views. Catherine obviously has a different view on that. But yeah, my own view is, yes, I think it will be sufficient to bring us back to target sustainably.
Thank you very much, Mr. Coley.
Before we move off this topic,
just if you briefly.
Thank you, Chair. Before we move off this topic, Dr. Mann, could you just, for the less educated in economic policy, can you just explain a little bit more about your sales surprise approach and like what that actually means? Can you just elaborate a little bit more on productivity on that one?
So we can send you the research paper done by bank staff. So the DMP panel, which we've already talked about, or some of the questions that they ask is, what do you think your sales growth is likely to be over the next year? And then, since it's a time series panel, we've asked that question multiple times over the years. We can compare what they thought they were going to get in terms of sales and against what they actually did get as an outcome. There's a distribution of surprises from what they thought they were going to get versus what they did. When there's a positive sales surprise, and then we can factor that, how do you react to that with investment? How does interest rates matter, or the cost of finance? And the sales surprises dominate the investment decision. In fact, financial conditions are not relevant, which is also something we see in macroeconomic analysis as well. So that is what I mean by a sales surprise and how firms react in terms of undertaking investment.
We'd love to see that paper, I think. Yeah, it was really, really interesting. Thank you. Bobby Dean, MP.
Thank you, Chair. I'd like to move on to the labour market data. And I apologise in advance to the Governor, because I know he preceded his comments in the Mansion speech with this, oh dear, as his phrase was, when we were talking about this section. Before we get into the sort of data issues, can you just explain to me more broadly what impact the labour data has on your forecast, how integral it is to what you write?
Well, it is. Now, just to be clear at the start, we're talking here about the quantity side, not the pay side. Pay side's a different survey. It doesn't have the issues that the quantity side, the labour force survey, does. No, it is integral because we take a number of things out of it. So one is obviously the employment. Another one is unemployment, which is people who don't have jobs but are seeking to have jobs. The third one, which historically tends to get less attention but is actually very important at the moment, is what's called participation, which is people who don't have jobs and are not seeking to have jobs. Now, just to give a bit of background on this, what we saw during COVID, and this was quite common across many countries, was that there was an increase in so-called inactivity, i.e. non-participation. The UK was not unusual in that respect. What's more unusual is that most other countries, you've seen that reverse as COVID has largely gone away. If you take the UK labour force survey at face value, that is not the case in the UK. Participation has not actually reversed its path. So that is very important, because that gives us that is a big signal on what we call the tightness of the labour market. Because obviously when people are not seeking to work, they are not putting pressure onto the labour market in terms of competing for jobs. Now, however, the problem we have at the moment is we don't know whether that is a good read or not a good read. And it's particularly an issue with participation. Unemployment, our staff can proxy that through other data series. We think we've got a reasonably good idea of how that's behaved, and we can compare that with the labour force survey. Participation, there just are not the same alternative measures of participation. We're much more dependent on it. You can use substitutes, the vacancy to unemployment ratio. It's not measuring the same thing, but it gives you a measure of the tightness of the labour market. But without that participation data, without the confidence in that participation data, it really is an issue. Moreover, underneath that is the second sort of set of questions the ONS asked people in the sample, which is why you're not participating in the labour. What is it that has caused you to become inactive? And again, I mean, the story is that there's been an increase in long-term ill health. Now, you may say, well, that's consistent with sort of increase in NHS waiting lists, but we don't know whether that's really that sort of correlation or causation. Yeah. So look, it's an important issue. That's a long way of saying it's very important. And it's not just important for us, of course, it's important for other aspects of public policy as well.
Mr. Dean.
Can I add one additional aspect of this, which is there are 3 different states that people can be in. They can be employed, they can be unemployed, and they can be not participating. The flows across these 3 different states tell us are very important to our understanding, because unemployment you can have an increase in unemployment as people come from inactivity into unemployment on their way to getting a job. That's kind of positive because they're drawn into like an expanding economy with more jobs. Or you can have an increase in unemployment because people are becoming unemployed, and then maybe they'll become inactive, but they become unemployed. That's kind of a bad signal for the economy. We don't have those flow data. And as a result, we really can't understand when unemployment changes. We don't know kind of which way it's telling us, the good direction or the bad direction.
No, yeah, I understand that well, and okay, sorry.
Right.
Yeah, I understand that point well. I mean, my dad was a scaffolder, out of work at the moment, and waiting treatment, and he would love to get back into the workplace, but he's not able to. But equally, we hear stories of GPs that have built equity in their homes, decide to move to the South Coast, and have no intention of returning to the workforce. And you're telling me that we just got no steer at the moment from the survey data about what proportion of those types of people there would be. Is that right?
Well, you get a steer from the LFS, as I say, people answer the same questions in the LFS, but the sample is now so small that it is not a statistically representative sample. That's the problem. So we don't know how much faith we can put in it.
Okay, that's right.
That's the problem.
Yeah. Yeah. So my final question is just about the sort of policy levers that we've got to address it, and I guess we don't know which ones to pull if we don't know the data. But could you explain to us what policy levers are?
Well, obviously the ONS are responsible for it. We work very closely with the ONS. We have a very good working relationship with the ONS. You may have seen the letter that Chief Economist Hugh Pill wrote, which was released recently, which actually also set out Catherine's point about the flow data. The ONS are doing a lot of work to, in a sense, try to sort of correct this. They've increased the sample size, trying to get more people into the sample. They're looking at, different ways of actually operating the sample. So they are working very hard at this. As I said, it's interesting. I said in the Mansion House speech. I mean, when I talk to my fellow central bank governors, other countries have versions of this, but they don't have as extreme a case of this as we seem to do. Why the UK has an extreme case, I'm afraid, sort of can't answer that one. It just seems a bit odd to me. But so look, the ONS are working very hard. And obviously, much better I'd probably ask the ONS for what they're doing, but they are working very hard at this. No question about that.
Thank you.
Yeah, and just going back to my point earlier on about potential reasons why people might be doing this. Would early take-up of pensions have a big effect on participation too? Not just people with equity in their loans.
So it's one of the candidate explanations. Obviously we've got an ageing population now, but I think the trend in non-participation goes above and beyond what you would expect, even for a given level of ageing of the population, because we sort of can broadly factor that in. By the way, having said that, there is another point that needs to be tackled in the labour force survey, which Hugh covered in his letter, which is it needs to be updated to use the most recent population numbers. However, we've got a reasonable idea about the ageing population. So one explanation, and I think one explanation during COVID always seemed to me to be, people were deciding to basically go into retirement a bit earlier than they would otherwise have done because of the impact of COVID. Didn't seem unreasonable at all. The puzzle is why the UK then has behaved differently to other countries, I think.
Is it gold-plated pensions for a certain cohort?
Sorry,
is it gold-plated pensions for a certain cohort? They've taken their pensions enough to live on compared with others?
Well, it's possible. I mean, Thomas, we just don't know the answers to these questions. And I should say that, it is certainly the case that the long-term sickness argument comes through strongly. And by the way, when I talk to people in the sort of health service, they say, look, it does accord with some of the things that they see. So it's not totally sort of surprising in some sense.
Lily McAvoy.
I was just going to say I think there are a myriad of different issues that are contributing to our lag of COVID bounce back. I think gold-plated pensions might be some for the very lucky few, but I think it's more likely the fact that a low-wage economy in certain areas in the region mean that actually combined with ill health outcomes and additional care responsibilities, we're seeing a problem here. In terms of the economic inactivity and the measures that the Chancellor has taken to try and get people back to work through the health spending, I'd be interested to know the panel's view on how quickly you think that would have an impact on getting people back to work with the reduction of waiting lists, but also with some of the addressing around the neurodiversity diagnosis coming early and the additional care support that we're giving. So maybe Dr. Mann first with your productivity hat on.
So I am not a health economist, and I would totally hesitate to try to answer any of your questions, honestly.
Okay.
Let me have a go. Look, just to be completely transparent on this, we haven't done a sort of, analysis of the specific details, nor would it be for us to do that. These are public policy issues. They're not directly in monetary policy, but, there are a few things that we can say. So, we do know some things from different sources of data. There is clearly an issue about long-term sickness, and in particular you can see some real changes there around, for example, younger people and mental health. So, anything that can help with that is clearly, and that is, the numbers that we've seen there are, in terms of the level of change, incredibly high. So, there's clearly an issue around young people and mental health. There is clearly, as the Governor said and you've alluded to, around an ageing population and sickness and ill health there. It is the case that a lot of that spending on health will go to people well beyond pension age, and so you might not expect to see huge returns in the sense of, for perfectly sensible public policy reasons, that's a good thing, but it might not help the labour market that directly. There are obviously a set of things we know about the sort of history of active labour market policies, and actually the UK, really has a good history here, and we know a lot from the evidence. It can take a long time for someone with ill health to rejoin the labour market. If you're in the sort of economically inactive because of ill health, you have sort of the health barrier, you then have a lack of work experience, and so just to bring someone from economic inactivity to unemployment can take a lot of intervention and time, and then from unemployment to working again. We've sort of the changes in society around reasonable adjustments, work, all of that is been going in the right direction, but some of these barriers are huge, so you wouldn't expect huge responses, very fast changes. The question about pensions, again, we just don't know, and it's quite hard to know, but is there a hypothesis? Is one of the reasons the UK is different because of that? Possibly. I mean, the challenge, as the Governor says, lots of hypotheses that could be behind this. If we had better data, we'd be able to distinguish them a bit more. Some people have tried. The IFS have done some good work in this space, and others, but very hard to know. Basically.
Thank you.
Yeah, I was just going to say, it's interesting that you mentioned about the mental health element, because we're doing quite a lot of work on this separately, but essentially there's quite a lot of differences in the mental health statistics. Again, it comes back to the data and what the story that we can get from the data, but some of the mental health statistics are double counting for the fact that it's causational mental health while they're on a waiting list for another part of another situation. I had somebody in my constituency who said they've got very severe, she worked for 40 years and she was asked to go back to work, but the job that they gave her was not appropriate for somebody with the disability that she had. So there's an appropriateness of that, how to get people back to work. So there's a whole new approach needed. But would you say that, so you think the impact of health spending in the budget, it might be long felt, but there are some things that we could intervene early on to ensure, to prioritise this group of people specifically?
I mean, I'm not a health economist either. I would say, the health spending in the budget will have been for wider public policy, for health reasons, effectively. There may be a knock-on benefit to the labour market, and we can be pretty confident the direction, right? It's going to be better for the labour market if you've got a more healthy population. But those transmission mechanisms are going to be pretty noisy, pretty lagged. And so you wouldn't expect to see a huge immediate dividend, not least, like I say, because of the age of the population that they will mostly target.
Thank you. We had similar from the OBR. Thank you very much. Yuan Yang.
Sure. To the Governor, so we have the situation where the UK has an unusually low participation rate, and not only that, people are unusually unlikely to participate in the actual labour force survey itself. What needs to be done to solve this problem? Who needs to do it? And is the bank doing any work to solve this problem as well?
Well, of course, first of all, we think we've got a low participation rate. Yeah. I mean, that's the question. Although, by the way, if we have a higher participation rate than we think, then the productivity statistics are even worse than we think they are. So
so whichever way, it's not
a
good.
Trade-off here. So we think that. We are, as Hugh set out in his letters, supporting the ONS, and we're obviously not the ONS, and we rely on them to. They're the experts in data and data collection, so we can't do that for them, but we participate very closely with them. We provide them with all the support and assessment we can. We've got our own team of labour economists who work very closely with them. So, I just don't want you to think that we're sort of standing on the sidelines throwing rocks. I mean, we've actually said to them, look, we understand there's a problem. We understand why this problem seems to have happened, although I find it puzzling the UK seems to be a bit of an outlier in this respect. But, we're totally supportive of getting this thing sorted out.
And how confident are you that the ONS can solve this problem, and by when do you expect that to begin?
I don't know when, because I think they've got a lot of work to do, and I think there's still a question of what it will take to get this sort of sample response rate up. So I don't think I could put a date on it, frankly, but there is a great deal of work going on, and they have, I know, been given more budget, more budget within the budget in that sense.
Thank you very much, Mr. Young. And the Monetary Policy Report highlights that credit card borrowing has gone up. Do you have any sense of distributional impact of that, given we've also seen savings rise as well?
Yeah, I mean, we haven't seen a sort of very sharp change in the sort of very, very low end, if you like, which we have been sort of looking for in that space. But you're right, we have seen uses go up overall, but it doesn't look to be disproportionately at one point in the income distribution.
Okay, that's helpful.
It's also important to make a distinction between usage and holding balances. Right. And I, in fact, have been very carefully looking at holding balances for exactly the reason is this sort of a way in which consumption is being maintained, but creates a vulnerability going forward. So the balances have not changed. The usage has changed, but again, we can think of it relative to pre-COVID, but again, we can think of that in terms of contactless payments being more convenient and that sort of a changing behavioral use of a credit or debit card.
At the moment, you don't have data for whether balances are being paid off regularly or people are holding balances on credit cards.
No, we do have that data.
Do have data.
Yeah, we do have that data.
Okay.
Can I just put an advert in? We will be publishing our next 6 monthly financial stability reports at the end of next week. We always cover the debt sort of situation, and I think we've already got a date for a hearing here on
yes,
that
we do. We have. I think you're back again very soon.
So we will be, we can obviously answer those questions in the context of the financial stability report as well.
Okay, thank you. Lola McAvoy.
Yeah. I had a question on stocks and shares ISAs, actually, and the use of them. So obviously in the Mansion House speech, the Lord Mayor talked about the lack of use of stocks and shares ISAs in the UK, and I wondered what your expert opinion would be on the potential impact of growth if there was more use of stocks and shares ISAs.
Well, I made the bigger point in my Mansion House speech, which is that I think we have to look very seriously and work very hard at changes and reforms which can encourage, and I use that verb carefully, I'll come back to that, greater investment in the real economy. Because again, going back to some of the discussion we were having earlier, the UK again has a poor record in this respect. And UK, I made the point in the context of UK pension funds, not again, I've said this a number of times, not because we should force we should not be dictating to pension funds where they invest. But however, the question doesn't go off the table for that reason, that the rate of investment in the real economy, i.e. in risk-taking and things that will create growth in the real economy is very low. So I think we do have to address these questions. Now, it's not really for me to say where we should do this or we should do that, but I do think we have to take this seriously. And by the way, I mean, it's something Mr. Glenn and I worked on a lot in previous life in the previous government in terms of long-term investment. It's been a subject that's been around for some time. And as I said last week, I'm afraid this is just a lot of heavy lifting, this work, but it needs to be done.
I just had a follow-up question on that, because obviously in 2018, the FCA said that 33% of consumers who'd drawn out their pensions early as part of the previous government's policy were leaving them as cash and not investing them at all. Do you think that was a potential missed opportunity for growth in the economy, and do you think there could be something to be done about how to support people who draw down their pensions early to have the confidence in sort of some of the other
I think I was chief executive of the FCA at the time, actually, so yes, I do remember that one. Yeah, I mean, the purpose of that work was to how could we actually improve the advice that was given to people on how, within sort of what I call reasonable risk management, they could actually get a better return on their pensions, because, again, there seemed to be too much of it being allocated into cash. I'd have to go and look at how much, what consequence. I don't carry it around in my head what the consequences of that were. But you're right. I mean, it's another aspect of the same issue. Yeah.
Thank you. Sometimes people have accused you of being over pessimistic in your forecasts. It's noticeable that your 26-27 forecasts are below the average, despite previous forecasts being proved to be pessimistic. So, what would you say, Governor? Is the bank being too pessimistic?
Well, I would say I think some of the outturns have not been far off where we thought they would be.
You are out of step with some of the other forecasts.
Well, I think it was Claire who made the point earlier that if you compare us with the OBR, I think they have a faster transmission in their assumption on fiscal measures than we do. On the other hand, actually, that's a question of speed of transmission, not overall scale of transmission so much. But we do have differences. I think they take a more positive view on the net trade contribution to growth than we do. But I have to say, net trade has not been strong in recent times. So I would sort of defend our view that I don't think we've been that particularly far off in terms of outcomes.
Okay, Tim Harriet Baldwin.
Well, a year ago, in your November report, you forecast that growth this year would be 0. What has it actually been?
It's been positive.
Can you just state what the number was? We've got in front of us 1.7%. Is that correct?
For 2024, we've got 1%, but of course, we're not finished yet with 2024. We'll see what the Q4 number looks like. This point about are we? I mean, look, I would say we're not pessimistic. I'm relatively new to the bank, but I do think some of the judgments we make they're realistic, right? So the OBR are more positive about the speed with which the budget will affect growth in the short term. They're more positive about trend growth and trend productivity than we are, but we have 1, they have 1.2. The difference is they still put some weight on productivity growth pre-financial crisis, and think maybe we'll see a return to some of that when we saw very high manufacturing productivity. We sort of are not expecting the economy to return to its pre-GFC levels, but who knows? There's all sorts of things. We could have a long conversation about technology, AI, all those sorts of things. But honestly, we take a very data grounded approach, as do they. So but these differences are not huge, I would say, between you may think there's groupthink amongst all economists, but I wouldn't say it's particularly in one part or the other. I mean, we all take quite similar approaches and come out with numbers based on the data, based on the models that are broadly realistic, I think.
I will make the note, however, that I've been here for 3 years, and we continually forecast an output gap opening up, as we have in this forecast as well, and that hasn't materialized.
Thank you. I just wondered, Governor, finally, if you've got any comment on how fast rate cuts are passed through. It has been slow in the past. Do you have any
Unless you're a saver, check.
Well, yes. But so yeah, have you got any comment for both savers and borrowers? Any message really for what you expect the banks to do?
We do expect pass-through to happen. If I take the savings side, the pass-through is now, on the way up, the pass-through was faster on fixed-term deposits than it was on sight deposits. So before, it didn't particularly surprise me because for another reason in our world, why we have changed the liquidity regime for banks in aftermath of the financial crisis. And we weight far more to the bank's sort of credit, as it were, in the liquidity calculations, fixed-term deposits, because they can't run as quickly. And so we didn't have a liquidity regime before the financial crisis. We do now. And so we do give more weighting for that. So it doesn't surprise me that the banks put more value on fixed-term deposits than they do on sight deposits in that context. Now, if you go to, as I said, we can't judge what we did last week because it's too soon. If you go to what we did in August, the pass-through so far into sight deposits, about half, I think, has come through. So in other words, the banks haven't yet passed on half of the cut, so that's still with depositors. Actually, a bit more, but for fixed-term deposits have come down more. So again, that's interesting that they're more responsive on fixed-term deposits. On mortgages, I think we were saying earlier, actually, that of course they're now essentially priced off the swap curve far more. They're not so much priced off.
You're not worried.
Position. Sorry?
You're not worried with how it's passing through.
Well, we monitor it very carefully. I gave a speech at Loughborough University earlier this year where I also made the point that I'm not surprised that as we've moved away from near zero interest rates, we have also seen banks adjust what I call their net interest margins. So they've actually reverted much more to what they were pre-financial crisis. Because when we took the official rate down to zero effectively, nearly zero effectively, the banks didn't take their deposit rates all the way down, actually. So the relationship between our rate and their rates sort of inverted almost from traditionally them being below us to being above us. that actually squeezed their net interest margins. And I'm not surprised that we've seen that as we've moved rates back into what I might call the more normal territory of
sort of recouping that.
pre-crisis. So that if you look at their net interest margins, they're now, last time I looked anyway, they're now pretty near to where they were pre-financial crisis in terms of net interest margins. It doesn't surprise me, really.
Okay. Thank you very much indeed. Look, I think it's been a very interesting session and very useful for us to understand your thinking, especially with the next rate cutting meeting coming up very soon. I think we've learned really that while inflation is falling more quickly than expected, risks do still remain, particularly relating to inflation in services, which all the figures bear out. And following this month's rate cut, future cuts are expected to be gradual, as you've all really highlighted. And we also heard that there are mixed signals on conditions in the labour market, which has been quite interesting and I think a knotty issue for us all to grapple with. There's also, we've heard that there's a range of views from you about the upside and downsides, risks of inflation, but it's great to hear these arguments and discussions played out in public, so we thank you for that. And we also learned that, of course, there are problems with data, making it difficult to understand the labour market, something that this committee is committed to investigating further. And that we heard that the global trade fragmentation isn't a good thing, but the bank will wait and see what the new US administration does, which it very much aligns with what the Chancellor was saying to us a couple of weeks ago. But can I thank you all very much indeed for your time. Order